Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We are focused on the meeting later today between Donald Trump and Xi Jinping. These leaders are set to finalize, call it a détente, as they meet on the sidelines of the APEC summit in South Korea. And this will put the trade war between the U.S. and China on hold, at least for now. Initial signals seem to indicate an agreement. Here's Bloomberg Sherry on.
We're expecting President Xi Jinping to arrive here in South Korea. He'll be arriving in the city of Busan, just half an hour ride from where we are here in Gyeongju. Now, this is his first trip to South Korea in 11 years, and it's also going to be the first in-person meeting with President Trump since 2019. We're expecting a trade truce between the two largest economies of the world, perhaps something along the lines of purchase agreements on soybeans, perhaps something around critical minerals. But President Trump said that he'd be open to providing China with access to NVIDIA's Blackwell AI processor as part of a trade deal. That would be a major concession. Of course, it's really been about those concessions coming from Washington.
That is Bloomberg Sherry on. Now, the other big story we are tracking has to do with big cap tech earnings. After the bell in the U.S., we heard from Microsoft, Alphabet, and Meta Platforms. For some reaction, I'm joined now by Daniel Newman. He is the CEO at the Futurum Group. Daniel, thank you so much for making time to chat with me. So much going on in markets. I'd like to focus on the earnings first that we had after the bell. We heard from Microsoft, we heard from Alphabet and Meta Platforms. Somewhat different stories, but I think the commonality here is the fact that these companies continue to build out AI infrastructure. At what point does that become a concern for you?
For me, it's when the growth stops. Every one of these CEOs understands something that those that are continuously saying it's a bubble or that this thing is going too fast is that this is the existential moment for these companies. Mark Zuckerberg's done this before. He made a bet on the metaverse that didn't yet pan out. And so people are kind of skeptical of his decision making. But if you actually look at the value he's brought to shareholders over time, he's continued to bring growth. And the numbers overall were very good. That one-time charge related to the taxes, the non-cash charge, threw a lot of people off. But if you actually credited for that, they actually beat on the top and bottom line. But if you listen to Amy Hood and Satya Nadella, if you listened to Sundar Pichai, and if you listen to Mark, they're all saying the same thing. We have constrained, we need more energy, we need more data centers, we need more AI compute, because their plans of how they want to build their businesses and deliver to the future require this.
So you were at the NVIDIA conference in Washington, D.C. in the last day or two, and I'm wondering what you took away from what Jensen Huang had to say.
Well, Jensen delivered his best keynote at a GTC so far. It was crisp, it was clear, it was tight. He had the partners aligned, he had the growth story aligned, but he really put one number out that I think sent that parabolic move that brought the company's market cap over $5 trillion. And that was when he showed that he had visibility by the end of 2026 into a $500 billion in revenue. Basically, every one of those CSPs that we just spoke about, all of these partners, he had partnerships with ServiceNow, with CrowdStrike, with Palantir. He announced a big partnership with the Department of Energy. All of them pouring investment, building products on the NVIDIA platform. And this just shows that there is so much momentum here. But the other thing, Doug, that I thought was really important was the diversification through all these partnerships. He went into quantum. He went into physical AI and robotics. They went into, of course, the traditional data center, the edge computing, and autonomy in vehicles. The business of AI is so much bigger than just the data centers. But what people have to kind of realize is it has to start there. It's like the brain of all of this build out starts with these data centers, and it proliferates into every part of our economy.
So NVIDIA, I think, is trading at around 44 times forward earnings. That seems to be historically a pretty rich multiple, but it doesn't seem to concern you at all.
Well, it actually traded at much higher multiples before this sort of boom at different times. You see AMD, you see Tesla, they trade at these great premiums, mostly because people have this belief. Now, NVIDIA, I think, gets a re-rating to some extent based on those forward comments about the visibility into the size of its business. But the company operates at the mid-70% margins. It delivers net income in the 50%. it looks like it could do $300 billion in revenue next year. So when you look at how it qualifies, and then you say, well, if OpenAI is going to be $1 trillion company coming out the gate, then NVIDIA delivering, nearly 120 to 150 billion of net income, depending on the exact outcome next year, it seems like that would be a business that could be very investable at that forward earnings. I like it better at 30 to 35, and that's where it's been trading. I wouldn't be surprised to see some new estimates based on Jensen's comments this week at GTC.
So I'm glad you mentioned OpenAI because the company is reportedly preparing an IPO soon, I guess, maybe as soon as next year. Reuters saying that it could value the company at as much as $1 trillion. You and I talked a moment ago. That's pretty much what you had to say a while back. And we know as a result of a deal in the last week, Microsoft now will have about a near 30% stake in OpenAI. But here's the thing. After the bell, Microsoft reports a steeper increase in spending than the street was expecting, and the stock in late trading on Wednesday gaps down by more than 7%. What's happening here with the Microsoft story?
Well, these two things are somewhat codependent, but somewhat not. Obviously, Microsoft, in this new way of positioning its relationship in the 27% or so that it holds, now has to report the losses. And OpenAI, while it might have $1 trillion valuation and its investment may have a great mark-to-market valuation for Satya and Microsoft, the cash losses are a responsibility of Microsoft, at least for their share. So that obviously is weighing, but I don't think that's what brought the market down. I think there was a couple of things that happened. One is it had a very strong run-up into earnings. It had seen its earnings, it's seen the stock price appreciate significantly. It went up over $4 trillion as well. I think there was a lot of enthusiasm. People were thinking there would be this big number. It did deliver a 40% Azure growth number. It did deliver an RPO number. They're saying they have $400 billion in revenue booked over the next 2 years. That these are booked orders, not potential orders. And to some extent, I think there was a little bit of just sell the news, Doug. I think people saw it run up. They saw, more CapEx, more spending. It's going to spook investors. I'm going to take some gains right here. But most of the thoughtful, tech-forward thinkers that I've been speaking to today have all commonly believe that these companies, these CEOs, Zuckerberg, Satya, Sundar, they are all doing the critical things they need to do to make sure that their businesses can survive. I think Zuckerberg keeps saying it best. I would rather be overinvested than underinvested here. So investors may have to be a little patient with the gyrations of the market when people react to that. But I overall think that these CEOs are doing the right thing, and I think this AI trade is very real. Okay, so let's go to Thursday. After the bell, tomorrow we'll hear from Apple, Amazon. What are your expectations from these companies? Well, Apple, it's going to be all about the new iPhone 17. We've heard a lot of positives about that Pro device, a lot of excitement. We've also heard some questions about some of those lower end devices. That thinner Air device hasn't necessarily done well. Apple's sort of been able to get that growth. It saw $4 trillion as well without ever actually really identifying its AI strategy. And I think that's because the market just believes its platform is so close to its consumer, the commitment level, people to stay on the Apple platform. So when you hear about OpenAI building something that's going to disrupt it, or Meta, I just don't think people believe it. And they think Apple might be a safer investment. They certainly haven't laid out those CapEx dollars to nearly the extent of these other Mag 7 companies. Amazon, they had that big outage. They've got to show some growth in that AWS business. You had Google over 30%, I think 34% today. You had Azure's, Microsoft's cloud business at 40%. Amazon's been trailing, and it's been trailing because it came out late. It underinvested to the point I made earlier. They underinvested with NVIDIA, didn't build out enough capacity. Their growth, despite being the biggest player, their growth has been much slower. They've been in the teens, trying to get back to the 20s. And I think the market needs to see that growth. I think their commerce business will do well. I think Amazon's absolutely knocked out of the park there. They've been, finding these cost efficiencies. That obviously comes with two sides. People don't love all the cost cutting, if from the world standpoint, but investors tend to like those actions. So Amazon, though, I think it's going to ride the way the market will respond on. Does AWS grow enough, and have they shown that they've been able to overcome those capacity constraints that have worried investors in the last few quarters?
Before I let you go, I want to get your take on Qualcomm. Earlier in the week, we had news that the company is developing a new AI chip, and I think it was Monday, the stock popped about 11%. What's your story on Qualcomm here? Is it worthwhile? Do you think that this company has a chance to go up against NVIDIA in any way?
I think everything against NVIDIA train of thinking is a bit problematic here. I think Qualcomm has a lot of engineering prowess. They hold, an exorbitant amount of patents. They understand low power, efficient design, and they have invested and bought some really good intellectual property for compute. I think what they actually launched is complementary. I think in many ways there's this, and Doug, you probably heard about inference versus this training boom.
Yep.
NVIDIA owns that market, and AMD has basically taken what's left along with some of those custom Broadcom chips. I think Qualcomm, in that deal that they signed with Humane, they're really going after this inference, which is going to be this higher volume, this more efficient computing at the edge. I think they're going to find some efficiencies in their pricing and how they market themselves. But here's the biggest thing for investors to think about. This is a company that's been trading around 13, 14 times. Maybe they got a little boost after Monday. Forrest, we talked about, NVIDIA at 45. This is a company at 13, 14. They got a little bit of a boost here, but they win 1 or 2% of the market share. Our estimates show that could be $6 to $12 billion of incremental revenue for them by the end of the decade. So I think they can win big, even if they only win small in that market. And I think they have the abilities to win a small piece of that market.
Daniel, we'll leave it there. Thank you so very much. Daniel Newman is the CEO of the Futurum Group, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Let's turn next to the Federal Reserve. We had policymakers cutting the Fed funds rate by 1/4 point during the last session. Now, that move was widely expected. The aim is to support a softer labor market. However, the path forward seems less clear, especially since there's been a lack of economic data resulting from the government shutdown. That's one reason why Fed Chair Jay Powell cautioned against assuming the Fed will cut rates again in December.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
At the same time, Powell said the Fed will stop shrinking its balance sheet after some recent stress in money markets. Joining me now for a closer look is Sean Clark. He is the CIO at Clark Capital. Sean is on the line from Philadelphia, Pennsylvania. Sean, thank you for making time to chat with me. This move on the part of the Fed to lower interest rates 1/4 point today was widely expected. There's been a lot of suggestions recently that the Fed needs to pay attention to a weaker labor market. But Powell seemed to push back on this idea that the market is expecting a rate cut in December. He said it's far from a foregone conclusion. What do you think is driving his thinking here?
Look, I think you're right about that. He actually said that, I believe, 3 times in the press conference. I think what's driving him, I think he's looking at a more balanced picture when it comes to weakening labor conditions and a little bit of elevated inflation. I still do think, however, that the Fed still is more worried about weakening employment than they are inflation. And I think the Fed does see that there's continued gradual cooling of the labor markets. I just think for right now, with a lot of lack of data, given the government shutdown, I think the Fed wants to take a little bit more of a measured pace.
Financial conditions, I think you could agree with me, are pretty much have been regarded as being very loose right now. And I'm wondering whether that creates a bit of concern for you.
Actually, no. I think when we look at the bigger inflation picture, we still remain within the context of a deflationary trajectory that has really defined the cyclical bull market that began in 2022. A lot of that, Doug, as you mentioned, has to do with easy financial conditions, lower interest rates, lower dollar, higher stocks. I think we get a continuation of that into year end and well into next year before I think we start to run into some volatility into and ahead of the midterm election. So my opinion is no matter what the Fed does right now, I think they're still going to be cutting into next year. Whether or not they cut in December is more of a coin toss right now. And overall market expectations have dialed back Fed cuts by one rate cut into the end of next year. I am not too concerned. I actually think it's a positive that the Fed is going to be cutting in a more gradual pace, not so much in a reactionary tone, but maybe a little bit of precaution.
What does it say to you that the Fed is going to stop shrinking the balance sheet? One of the things I think Powell focused on was some recent stress that we have seen in money markets. And I'm wondering whether that represents any concern for you, that the Fed is going to stop a process that the market had been kind of looking forward to almost.
Yeah, I think the Fed really needed to deliver on three key points today. Now, one was a rate cut, check. Second was they needed to message the QT and ending the balance sheet runoff, check two. And third is dovish language. We didn't quite get that. But back to the balance sheet runoff comments. There have been signs that reserves are no longer really abundant. And I think a lot of that's evident by the fact that we've seen repo rates that have been running pretty much consistently above the midpoint of the Fed funds target range for quite a while. So there were some signs of stress. Now, we do know that the Fed did message that they're going to be ending the runoff and keep the balance sheet at a constant level starting on December 1st. They are still going to be reinvesting treasuries at the auction. They're going to be rolling those over. But principal payments and payments from MBS, they're going to be reinvested in T-bills. I think what that potentially does longer term possibly increases demand on the short end of the curve. And I think that actually could steepen the yield curve, which, for bank earnings, that probably is not a bad thing.
I'm interested in getting your perspective on the banks in a moment, but talk first about this move lower, pretty dramatic across the curve in terms of yield. We've got a 10-year right now at around 360. Would you put money to work at the short end of the curve right now on the long side?
No, I would not. I would go more to the belly of the curve or maybe extend a little bit more in duration. I would stay away from the short end of the curve just because I think a lot of the gains have been had. With that said, I do think the path of least resistance for most of the yield curve probably is still a little bit lower, right? We are in a defined downtrend in yields. When you look at the 2-year yield, the 5-year yield, 10-year and 30-year yields, from a technical standpoint, all of those yields, 50-day moving averages, are trading below their 200-day moving averages, which to us is one of the key definitions for a downtrend. So I still think we get lower yields. The fact that we punctured 4% on the 10-year to the downside, we're a little bit elevated above that right now with a little bit of backup in yields over the past couple of days. Getting through that 4% on the 10-year tells me next stop is probably 3.8% on the 10-year yield. And after that, we might be looking at 360.
And yet inflation remains above target. It's rising still. And Powell today said near-term inflation expectations have risen. That doesn't concern you in the least.
Well, inflation concerns me, but I still believe that we are in a disinflationary trajectory. When we look at the components of CPI, most of those components are actually in deflationary territory. And we look at what Powell said today with regards to the various components and how the Fed breaks it into three different subsets. Shelter X hotels or shelter goods inflation is being affected by the tariffs, which is elevated. That's to be expected. Housing services has been down. That's a reflection of shelter costs acting as a lag, which shelter costs represent about 43% of core CPI. They are deflating. That should continue because they operate with a lag. Finally, non-housing service inflation, Powell comment is being You put all of that together, it doesn't seem like the inflation picture is all that bad.
Okay, let's go back to the banks now. We're talking about maybe a little bit more steepening of the curve, albeit in an environment where rates overall are drifting lower. Do you like the bank stocks here?
We do own banks. I think they've had a pretty big correction given some of the concerns with regional banks and quite frankly, some of the loans. I would use this weakness in banks as a buying opportunity, as opposed to getting overly conservative and too cautious on the industry group by itself.
Is there a risk that some of these banks may still be exposed to problems in the credit space where we're talking about maybe a credit line to a private credit firm or something else that remains at this point unseen, undisclosed? We don't really have a lot of visibility here, and I'm wondering whether that represents the slightest concern for you.
Well, there's always risks, and certainly that is a risk. I do think the whole private credit space is a risk. What we saw a couple of weeks ago with some bad loans and some defaults. Yeah, I mean, Jamie Dimon's comments about cockroaches. Sure, there may be more. We really focus on overall credit conditions. And when I look at credit spreads are historically low. When we begin to see credit spreads rising, that's when we're going to start to get concerned with overall credit conditions, which normally rise. Credit spreads normally begin to elevate prior to market turmoil. We just, quite frankly, are not seeing any of that at the moment.
Okay, Sean, we'll leave it there. Good stuff. Thank you so much. Sean Clark is CIO at Clark Capital, joining from Philadelphia here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.